Welcome to This Explainer. Okay, listen up. If you're a young adult just starting to earn some real money, you actually have the absolute greatest financial asset in the world right now, and that's time. But man, I see so many young professionals completely waste that advantage just by getting distracted. You know how it is. You hear the noise. You see the trendy investments, the latest cryptocurrency, the hottest tech stocks, and you just want to jump right in. But the truth is, building true, lasting wealth, it isn't about chasing trends. It's about following a strict, mathematically optimal, step-by-step blueprint. So today, we're cutting through all that noise to give you the exact order of operations you need to build an absolute financial fortress. Okay, let's dive into this because this quote perfectly captures what drives me absolutely crazy as an advisor. Watching people throw money at the stock market like they're feeding coins into a slot machine while completely ignoring the massive holes in the bottom of their financial bucket. Look, buying risky individual stocks or crypto before doing the boring foundational work is just madness. It's like skipping straight to the fun stuff without realizing that purely by the numbers, you are literally setting yourself up to lose. And, well, this staggering number is exactly why. 22%. That is the average credit card interest rate right now. Trying to invest in the stock market while carrying high-interest credit card debt is literally like trying to run a marathon with a backpack full of rocks. Sure, you might be making some forward progress with your investments, but that 22% compounding against you, that's a financial cancer. It is mathematically guaranteed to wipe out any reasonable investment returns you could ever hope to make. So, to fix this, we're going to follow a rigid blueprint today. Think of our agenda as a house-building sequence. We're going to start with the wealth-building illusion, move into pouring your financial foundation, then claiming your free money, hitting the tax optimization zone, and finally venturing into the Wild West of investing. All right, kicking things off with Section 1, the wealth-building illusion and how to avoid the Ferrari trap. You know, the opportunity cost of getting your financial order wrong is just massive. Skipping the boring foundational steps so you can buy individual stocks is like asking if you should buy a Ferrari when you literally don't even have the cash to fix the broken transmission in your current car. And to put this illusion into perspective, look at this, $500. According to recent data, that is the shockingly low median amount Americans have saved up for emergencies. That's less than a monthly car payment for most people. And it actually dropped from $600 just a year ago. Seriously, 1 in 3 Americans doesn't have an emergency fund at all. Yet these are the exact same people asking if they should buy the latest hot ETF. Before you invest a single dollar, you need a psychological safety net. Vanguard research actually found that people with just a $2,000 emergency buffer had financial well-being scores 21% higher than those without one. So it's not just math, right? It's peace of mind. Without this buffer, one flat tire or unexpected medical bill forces you to sell your investments at the absolute worst time or rack up credit card debt. My advice to you, save your first $1,000 as fast as humanly possible, then build up to 1 month of living expenses, and ultimately aim for 3 whole months. Once that safety net is in place, we move right along to Section 2, pouring your financial foundation by eradicating toxic debt. Now, I define toxic as any debt charging you over 8% annually. This is the stuff that actively destroys your wealth-building potential. You've probably heard of the debt snowball method, where you pay off the smallest balances first to get a quick psychological win. But as a young adult trying to optimize your wealth, you need to focus on the debt avalanche. So the crucial point is, mathematically, the avalanche method, paying the highest interest rate first, is overwhelmingly superior. Think about it. If you have $5,000 in credit card debt at 22%, making only minimum payments means you'll pay nearly $2,800 just in interest over 5 years. Every dollar you throw at that debt pays you a guaranteed 22% return. That beats Warren Buffett's long-term average, hands down. Now, there is exactly one, and I mean literally one, major exception to the no investing while in debt rule. Section 3, claiming your free money through the employer match. I really want you to lean in closely here, because this is essentially a massive financial secret hiding in plain sight. If your employer offers a match on your retirement plan, it is often a guaranteed 100% or sometimes 50% immediate return on your investment. Let me repeat that, guaranteed. Even if you're carrying that awful 22% credit card debt, an immediate 100% return easily beats paying off the debt. It's basically like finding cash on the floor that your boss promises to double if you just pick it up. So contribute exactly enough to get the full match and then redirect all remaining cash right back to your toxic debt. Just be sure to check your company's vesting schedule so you actually know how long you have to stay to keep those matching funds. Awesome. So once your emergency fund is flush and your high interest debt is completely gone, we enter Section 4, the tax optimization zone, maximizing IRAs, HSAs, and 401ks. You know, most people actually skip this zone and go straight to regular brokerage accounts, which literally means unnecessarily handing your own money back to the IRS. No way! The big decision here is traditional versus Roth. Traditional accounts give you a tax deduction today, but you pay taxes when you withdraw in retirement. Roth accounts require you to pay taxes upfront today, but your money grows and is withdrawn completely tax-free later. Listen, as a young adult, you are likely in the lowest earning years of your entire career. Your tax bracket is probably only going to go up from here. Because of that, you should heavily lean toward Roth accounts to lock in today's low tax rates. For 2025, you can contribute up to $7,000 into an IRA. And an IRA gives you way more control and much lower fees than a standard corporate 401k. Now, what's really interesting about this slide is that this is the most underutilized investment vehicle in America, the health savings account. If you have a qualifying high-deductible health plan, the HSA is an absolute game changer. It is quite literally the Swiss Army knife of wealth building. So the HSA offers this amazing triple threat tax advantage. Contributions are tax-deductible on the way in, the investment growth is tax-free, and medical withdrawals are tax-free on the way out. For 2025, a single person can contribute up to $4,300 or $8,550 for a family. And here is the ultimate pro tip for you. Pay for your current medical expenses out of pocket if you can. Leave the HSA money invested in the market and keep your medical receipts. There's no time limit on reimbursement. You can let that money compound for decades and reimburse yourself tax-free 20 years from now. How cool is that? Finally, that brings us to Section 5, the Wild West of investing, taxable accounts. Now, you only step into this territory after you have mashed out your IRA, your HSA, and gone back to max out your 401k up to the massive $23,500 limit for 2025. Taxable accounts offer extreme flexibility, no withdrawal restrictions, no contribution limits, but they come with a brutal catch, tax drag. And this brilliantly illustrates the catch. If you invest $10,000 annually for 30 years at a 7% return in a tax-advantaged account, you end up with about $944,000. But put that exact same money with the exact same return in a taxable account where the IRS taxes your dividends and capital gains along the way, and you end up with roughly $700,000. You lose nearly $250,000 simply by investing in the wrong type of account. Let's move to and see how this builds together into your strict order of operations. Step 1, build the emergency fund and kill high-interest debt. Step 2, grab that free employer match money. Step 3, maximize the tax optimization zone with your IRA, HSA, and the rest of your 401k. Only then do you reach Step 4, investing in taxable accounts. Wealth is built sequentially, folks. You don't get to skip to the fun stuff without pouring the concrete first. So what does this all mean for you? I'll leave you with this question. Are you building your financial house on solid rock, or are you investing on quicksand? Do the boring foundational work first. Follow the math, optimize your taxes. I promise you, your future self is going to thank you for resisting the urge to buy the flashy Ferrari when what you really needed was to fix the transmission. Thank you so much for joining me for this explainer. Now go out there and start building that foundation.